Assalamualaikum. Our group choose topic risk, return and valuation. This is our member group. We have Natasha Nurfaiza binti Jumansa, Lukman Hakim bin Muhammad Kamal, and Nurul Wadina binti Amran. This is our content for this video. The first one is introduction, second methodology, third finding, fourth conclusion. Assalamualaikum. My name is Natasha Nurfaiza binti Jumansa. The first one is introduction. There will be introduction topic, introduction of two articles, and comparison. For introduction topic, risk, return, and value are the key financial concepts that support investment choices and economic analysis. According to Papazen 2023, risk is the uncertainty and possible fluctuation of return connected with an investment. It has several aspects, including market risk, particular risk to individual assets, interest rate risk, and geopolitical risk. Next, return. According to Liu 2023, return is the profit or loss made by an investment over a specified time period, usually set as percentage of the initial investment. It is a reward for investing cash and accepting risks. Valuation. Valuation is the fair worth of an asset or organization, which is critical of making investment decisions. According to Rockman 2020, valuation approach include discount cash flow (DCF) analysis, comparable company analysis (CCA), and precedent transaction analysis. This topic was chosen because it covers the fundamental ideas guiding investment policies and financial decisions. Understanding how risk, return, and valuation are related helps create a well-diverse and balanced portfolio that maximizes benefits while lowering risk. Learning this topic also helps us obtain the key analytical abilities required for a job in finance. It offers a closer knowledge of financial theories and their useful relevance. Introduction, Article 1. The first article titled A Study on Risk and Return Analysis and Data Envelopment Analysis of Public and Private Sector Banks by Venkatesh et al. 2021. This is a study to investigate the relationship between risk and return in the context of banking sector, such as market fluctuations, credit risk, operational performance for risk, and etc. The study was analyzed the performance of nationalized banks. It is chosen from banks listed on the National Stock Exchange (NSE). The method that used in this article is risk and return analysis and employs a non-parametric method, which is data envelopment analysis (DEA). For the decision-making, units become more efficient. It is by make a comparison between the input to the output. Hence, this study contributes a deeper understanding on how to manage the investments and policy decision in the future. Introduction, Article 2. The second article titled Risk Return Analysis of Portfolio Management based on Markowitz Model by Lakshmi et al. 2023. This is a study to get understanding on balancing the risk and return before making an investment decision. This study also using comparative analysis on various levels of risk and return to help the investor having a deeper understanding of the trade-off between risk and return. The method that used in this article is risk-return analysis and also utilize the importance of Markowitz model, a theory that focuses on the importance for construct an investment by considering the correlation between different stocks. And Sharpe ratio helps the investor to make a comparison between different investments' performance or provide a valuable insight on how much return that they can get from a particular risk level. Hence, this study provides a well-informed decisions for the investor that is seeking to get the risk and return balance and more efficient. For comparison on part introduction, the similarities of these two articles are both focusing on the relationship between risk and return in financial context. The difference for optimizing returns and minimizing risk for a given level, the first article is about bank performance and the second article is about investment efficiency. Secondly, the first article compares the risk and return in bank sectors, and the second article compared the level of risk and return in different investment options. Third, The first article is using DEA, utilize the models to assess bank efficiencies, and the second article is using Markowitz model and Sharpe ratio. It is to optimize the risk and return on investment. Hence, both articles provide a deeper understanding of financial optimization and efficiency.
Hi, my name is Nurwadina binti Amran. The methodology for Article 1. The data was collected from the National Stock Exchange NSE website, where the data obtained was the secondary data, and in order to analyze the performance of banking sector, and the researchers consider Bank Nifty index as a benchmark. The sample data was 12 months prices of stocks related to banking sector listed in Bank Nifty. So the metrics used at analysis were first rate of return using the calculation using the close and opening price of stocks. The rate of return will evaluate which bank stocks perform the best and the worst. So next we have beta. So beta will measure the sensitivity of stock price relative to the market index. So the beta will assess the sensitivity of different bank stocks to market movement. Then we have a coefficient of correlation. So it will determine the relationship between security return and the market return, where the correlation value obtained will determine how closely each bank stock's performance is related to the market. And then we have a standard deviation. The standard deviation will measure the risk and volatility of stocks. So standard deviation will identify the risk associated with each bank stocks. And then lastly, we have data envelopment analysis, where the performance ratio will calculate in order to rank the bank.
Assalamualaikum warahmatullahi wabarakatuh, madam. My name is Luqman Hakim. Now I will explain methodology article 2. For portfolio performance analysis, the data provides an analysis of the performance and risk characteristics of various portfolios, including Tata Steel, DLF, and ICICI Bank. This can be used to assess the relative performance and risk profile of this investment. For correlation and risk metrics, the analysis includes correlation coefficient, standard deviation, and risk metrics that can be used to understand the relationship and viability between the different portfolio and components. For methodology explanation, the article describes the use of the Markowitz model, a well-established portfolio management technique, to conduct the analysis. For potential application, the insight from this analysis could be used to inform investment decision, portfolio optimization, and risk management strategies for investors and financial institutions. For limitation and caveats, the article notes that the portfolio standard deviation is more difficult to compute than the standard deviation of individual securities. This highlights the need to consider the limitations and assumptions of the analysis.
Similarities of articles. So both articles focus on analyzing risk and return in the financial sector using quantitative methods. They employ statistical measures such as standard deviation, correlation of coefficient, and beta, which is all this in Article 1, and portfolio variance in Article 2 to assess the performance of various financial assets. So both studies utilize the secondary data for their analysis. So Article 1 using data from the Bank Nifty index, and the Article 2 using data from the Sensex market. So additionally, both articles emphasize the importance of understanding the relationship between risk and return for making informed investment decisions. Next, the difference of the article. Despite the common focus on risk and return analysis, the article differ in the specific objective and methodology. So, Article 1 by Van Kartesh et al. Primarily analyze the performance of public and private sector banks listed in the Bank Nifty index using the measures like rates of return, beta, and the standard deviation to assess individual bank stocks. The study also incorporates data development analysis (DEA) to rank the efficiency of banks based on their deposit per employees. Conversely, Article 2 by Lakshmi et al. Focus on constructing an optimal investment portfolio by analyzing three specific stocks, which is Tata Steel, DLF, and ICICI Bank from the Sensex market. So this study used measures like average return, variance, and portfolio risk to determine the ideal asset allocation for minimizing risk and maximizing return.
Next, I will comment on the comparison. While both articles offer valuable insight into risk and return analysis, they cater to different aspects of financial analysis. Article 1 provides a detailed performance assessment of individual banks, highlighting systematic and unsystematic risk, and ranking banks based on efficiency. This approach is useful for investors interested in the banking sector, offering a comprehensive view of individual bank stocks. On the other hand, Article 2 provides a broader perspective on portfolio optimization, emphasizing the importance of diversification and the correlation between assets. This approach is beneficial for investors looking to construct a balanced portfolio that maximizes returns while minimizing risk.
Okay, move on to the finding. So for Article 1, the study revealed that Bank of India, BOI, has the highest return of 61.04%, while Bank of Baroda, BOB, has the lowest return of 3.87%. So the study also revealed that Punjab National Bank and BOB has the highest divisions, indicating the highest risk. Meanwhile, Asia Bank has the lowest division of 2.52%, indicating less risk. The analysis also showed that all 12 bank Nifty stocks has a positive beta value, with 5 of them having a beta value of 0.2% to 1%. The analysis also revealed no negative link between Bank Nifty listed stocks and the Bank Nifty market index. Indus Ind Bank is the most efficient bank, accounting for the largest total deposit per employee. But finally, the study will not advise investor on which stocks to invest in and which to avoid, because the company ratings are determined by investment and investor type.
Findings Article 2. According to the methodology presented in Article 2, choosing assets with minimal correlation with one another will help to create an ideal portfolio. While trying to optimize returns, this diversification approach is meant to lower total portfolio risk. Using mathematical method, the model finds effective portfolios along the efficient frontier. The article underlines that investors, especially those who are interested in DLF and ICICI Bank, search for greater returns while keeping minimum risk.
In conclusion, the analysis of risk, return, and valuation display crucial roles in make an investment decision. In this study, both articles provide a deeper understanding into this topic with different perspectives. Besides, the financial analysis in both articles applied a diverse application of quantitative techniques in achieving the financial goals. The finding from the first article emphasized the variability across both bank sectors. The finding from second article demonstrate a valuable strategy to risk mitigation. Overall, this study provides 3 suggestions that can give a valuable insight in the future. The first suggestion is expansion to other sectors. Future researchers can extend the analysis to a various sectors beyond banking and the other companies. The second suggestion is using an advanced analytical model. Future researchers can explore the latest or advanced analytical model such as artificial intelligence AI tools. Lastly, the third suggestion is understanding the behavior finance in investment decision. It is an economic theory that explains often irrational financial behavior. That's all from us. Thank you.